Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Max Cabasso, Managing Director on the Nasdaq Market Intelligence Desk, Michael Normyle, U.S. Economist at Nasdaq, and returning Eric Sterner, Chief Investment Officer of Apollon Wealth Management. We're here to discuss why investors should consider the quality factor and focus on companies with strong balance sheets, cash flows, and earnings track records. It's great to have all of you with us. Welcome to Trade Talks. Eric, welcome back to the show. It seems to be some sage advice for investing in general. Before we get into some of the fundamentals there, the market rally, it's quite a surprise from Jackson Hole. I don't think many were expecting the velocity of it.
Yeah, it was very un-Powell-like, that speech. He's been very hawkish recently, and just for him to say that the tariffs will probably be a short-term effect, and I think that surprised many market participants, even though others have been saying that between Waller and Bowman. But to hear Powell say that, I think that really set that market rally. And there's a lot of uncertainty being removed from the markets between some of the trade agreements being put in place, as well as the one big beautiful bill being signed into law. So I think removing some of that uncertainty that just clouded the markets back earlier this year is really helping drive this market rally.
Yeah, but Max, has it really removed uncertainty? There's some can kicking.
It's a bit more can kicking. I think the big uncertainty, like we saw going to Jackson Hole, the odds for a rate cut, 65%, immediately jumped for 90, up to 90%. That's essentially priced in now. We're getting a cut in September. If we don't, that would be pretty shocking. I think it was just that, when are they going to turn? When is the Fed going to come out and give us more dovish statements? I don't think it was, like he was talking about, it was not anticipated to be that dovish, that the 2% inflation target, which has been the anchor forever, that's not so much there. It's really about the jobs now, which we talked about last week as the concern, but there's still, now, how does that impact everybody else across the board? Do we finally catch a bid in some of the small and mid caps that have been waiting for that cut? Will that help their profitability? Like we were talking about before, is that reshoring actually going to happen? There's still question marks out there, and look, as much as I like the rally, we're in the last week of August, leading into Labor Day. It's a bit quieter. We do have some, obviously, large earnings prints coming out. Last night, pretty good. We have a big one today. I just think there's a bit less, volume going on there. There's not as much activity, so I think some of the moves are kind of exacerbated just because there's not as many market participants. So the big questions we were, kind of asking are answered, but what are the ramifications of those? That is, always going to be, a continuous question.
Yeah. What do you think the expectations are in terms of the amount of cuts in September? 1, 2?
I think one is really if it's more than one, then there's a problem, yeah. I would say. And honestly, I'm a little bit surprised that, the data-dependent Fed signals so strongly that we're going to be cutting in September when we have another jobs report and another inflation report before that meeting. And I don't think it's entirely out of this world if the soft jobs market that we saw in May, June, July was companies saying there's all this uncertainty, so I'm going to hold off on hiring a little bit. And now the certainty that we're talking about coming back a bit, maybe they feel more comfortable bringing that hiring back, and a stronger jobs report in August doesn't seem totally out of this world to me, or maybe it is September. But the market's view is there's a 10% chance of that, I guess, basically.
Yeah. I wonder if it's not necessarily they're hiring because of financial restrictions, but perhaps they don't understand what the environment's going to look like with the impact of AI going forward and the types of people that they need to hire. So perhaps there's a wait and see with that.
Yeah,
I mean, it's conjecture, obviously.
There could be multiple factors, right? And that could certainly be one issue for sure.
Yeah, and I think overall, to your point, Eric, looking for those companies that have delivered solid earnings and the fundamentals are strong. Part of that point is we don't know what the ROI looks like yet, or how industries are going to be impacted. So when you're looking at companies, you do need to be invested in the market. What are some areas? What are some sectors? What are some fundamentals you're looking for?
Well, I do think the market has gotten a little frothy right now. I am bullish, but just even looking at factors back in July, the high beta factor was up 5.5%. And you typically don't see that when GDP, economic activity is slowing down, consumer spending slowing down, the labor market is softening. So I think we will see a pullback of some of those more unprofitable companies. And that's why I think investors really should more focus on quality, like I said, not a complete risk-on environment. And there's certainly plenty to choose from. We've seen financials. I'm really bullish on financials. They've had a strong year with less regulation most likely on the horizon, more M&A activity, more IPOs coming out. And then the tech, while the valuations and between communication services and technology, we know there's high valuations there, but they keep on producing these incredible results, and they're very cash-rich companies. So I think there's a strong quality tilt there. And then, of course, the utilities play. Utilities, for so long is that perception of being a defensive play, but now with AI and needing that much more power demand, power demand was growing 1% to 2% over the past 10, 20 years. It's expected to increase up to 8% over the next 10 years with all these data centers being built. So I think there's plenty to like in this market, but I still would not, it's not a complete risk-on environment, and I would advise clients to tilt away from unprofitable companies.
What about international equity exposure, which was leading the way in the beginning of the year?
Yeah, I mean, I'll always be an advocate for international equity exposure, and I think as the world slightly backpedals from globalization, we're going to see the more diversification benefits of having international in a portfolio with domestic equities. But I think the domestic equities may take the lead in the second half, or perform better in the second half of this year. There's some headwinds on the international front, I think. There was a lot of front running before the tariffs that helped international companies. And now with the dollar depreciating, that's only going to help American companies selling overseas and hurt international companies. So I expect while international companies, there's still a lot of great stories out there between Japan and others, but I think the U.S. will continue to be the exceptional market.
Yeah, and Max, just because you're expecting somewhat of a pullback doesn't necessarily mean a correction.
No, I mean, I don't want to say we haven't seen it, but there's almost this passive bid that is just sitting there. Retail is a lot more involved, which has kind of been tamping down some of those drawbacks because the trade, like we've talked about for a couple of years now, has been buy the dip, buy the dip, buy the dip, do it until it doesn't work, and it's worked every single time over the past few years, where normally, historically, that might not have been the case. Over the long run, obviously, that works out, but the short-term dip buying has proven to be successful, so you're starting to see that, again, happen every time starting to see stocks start to wane a bit. People are stepping into that. A lot more options trading, a lot more short-term trading where you're there, hey, I'm going to take a shot to the upside, buy some calls against it. There's a lot more of that is sitting there to kind of help from these massive corrections. And like we talked about before we started rolling here, the valuations are very high, but a lot of these companies are actually profitable. They have cash, they're real companies. That's a bit of the difference with the .com bubble where it was total vaporware. Okay, some may say AI is like that, but you're seeing where AI is going. That train has left the station. You're not pulling it back. So that's why utilities, that demand is not going away. You're starting to see, okay, there might be some demand is not totally there. Some of these AI companies are not profitable, not really bringing in much revenue, but I don't really see that getting pulled back where we're going to scale away from where we're going. The build outs are going to continue to happen. So I think there's just that kind of natural bid. And I don't want to say the only game in town because it is good to have some international exposure, but the narrative earlier in the year was Europe is going to outperform. They've underperformed. That's in place because of tariffs. If you really look at the flows and where all the capital is and where companies are looking to list, because this is where the capital is. This is the U.S. market. It isn't the only game in town, but it is the majority. It is the biggest, the baddest that there is. So trying to avoid that, passing up U.S. investment is a risky strategy. So I also think foreign investors as well as U.S. investors are going to keep pouring money into the U.S. market.
Yeah, I mean, we've seen the brain drain revert.
Yeah.
Come back to the U.S., particularly the digital asset and blockchain spaces. Now that there's framework that's being slowly introduced and getting into place, and they understand what the operating environment looks like. But I think the question that we're hearing from strategists around the table is when it comes to ROI, we know the companies that have exposure to the AI story. We know NVIDIA. It's not a surprise. Now I think investors are thinking about, okay, we know these stories. We know they're going to have exposure. We know that's the direction that they're going in. Now let's start practically applying it elsewhere and see where the ROI is actually taking place. So you can think about the consumer space. You can think about, let's call it even Home Depot and Lowe's an example. We used that yesterday where they're investing in AI tools and the contract segment now. So I feel like when you look at those segments to see where the ROI is versus the actual tech companies, that's where the story is.
Yeah, and also where you were talking about with jobs potentially, that could be a cause for a pause because companies are saying, all right, we've now invested into these products, we're still investing into these products. Where is this going to help us? Is it with entry-level positions that we might not need to fill anymore because we have these tools that can do that? That's where you could start to see it start to pick up, where they say, okay, we are successful. What we've built is going to work for us. We've built it out internally. Now we don't need to hire 10, 20 people. We can have 2 people do this, and that might be that kind of cause for concern for jobs.
Cuts,
right, not cuts, but we might not have to hire as much because others are moving on, moving up in a corporation. That entry-level position, they might be able to do with AI now where you don't need to hire all those people to backfill it. And that's where you might see it, hey, we don't have to go out and hire. Again, not cutting everybody, you're not seeing all these layoffs everywhere, but the initial stuff, they might not have to kind of backfill nearly as much as in the past.
When do you start to get concerned with the employment number? Is it the rate? Is it specific number? Hourly wages?
Well, and I think if you look through the history of the data, you'll see in the middle of expansions a negative jobs print for a month. And I think if we get that now, people might be concerned because they forget that that happens. So even one negative jobs print wouldn't be too worrisome. But we also, with lower immigration that we have right now, the sort of break-even level of jobs that we need each month just to keep the unemployment rate flat has gotten much lower. And when that happens, it's much easier to go below zero. And so the risk of seeing a string of months below zero or a smattering of negative readings for over the course of a few months, that's when it gets really worrisome.
Yeah. What about small and mid caps, right? If you're thinking about other areas and other ideas to get into, I know you have your beta exposure there, but
yeah, well, we saw there was a big jump in those after the election because of the onshoring efforts that everyone thought was coming with this new White House administration. And they've been held back just because they're interest rate sensitive sectors and very economic sensitive sectors. So we saw small caps that jumped nearly 3-4% after the Jackson Hole speech. We'll see if that rally continues. Obviously, small caps, they need those interest rates to come down just because they have that much more floating rate debt on their sheets. But we still have some, like I said, we have some more certainty that we had in the spring, but we still have a China trade agreement to get in place. We still, I think a lot of these tariff concerns and inflation are a bit overblown, but time will tell. So I think there's still some uncertainty with the economy that might hold back that small cap rally. But if we can get some more, roads paved between trade agreements and more evidence of whether tariffs will truly be an inflation problem, then we could see a really strong performance between small and mid caps. And even the deregulation. I mean, the regulatory costs of mid and small cap companies proportionally is much higher than large caps. So we could see some really strong tailwinds there. And I think investors should always have exposure to both those asset classes.
But I also think, to your point earlier, you're looking for quality companies from an operating perspective in the earnings that they're delivering. If your only investment thesis is we're getting a 25, 50 basis point cut, and that's the only fundamental data point that you're finding for some of these companies, perhaps it's not worth the investment.
Yeah, I think it's just because when they run quick. So that's why I have exposure there and keep that quality till. I mean, if your investors are looking for mutual funds, ETFs, I would advise looking for something that's tied to the S&P 600, more profitable companies as opposed to Russell 2000 receive 40% are unprofitable. So that's why I would. We're more neutral right now with our mid and small cap exposure because of still some of these uncertainties that we have to remove. But once we clear it away and we potentially see a series of rate cuts, it's not just a 25 basis rate cut. I think just the expectation that the Fed will cut more, where the terminal rate is, we don't know yet, but we certainly expect 75 to 100 basis points to be cut over the next several months, most likely, unless inflation does become a problem again.
All right. Appreciate everyone's insights. As always, thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.